Right now, silver is sending one of the strangest signals we've seen in years. If you're in the United States and you look at silver prices, it feels like panic. Charts are red, headlines are screaming collapse, and everyone's asking the same question. But if you zoom out and look at global markets, something doesn't line up. Prices overseas are holding stronger. Physical demand outside the US looks steady. Suddenly, people are asking a question that won't go away. Is the silver price rigged, or is something deeper happening behind the scenes? Stay with me, because what you're about to hear isn't about conspiracy theories. It's about how silver is priced, who controls that pricing, and why the US price and global reality don't always match. By the end of this video, you'll understand why this gap exists, who benefits from it, and why it matters more now than ever. Welcome back to Silver Pules. If you want calm, clear silver market breakdowns without hype or fear bait, make sure you like this video and subscribe to the channel. It helps the channel grow, and it helps you stay ahead of emotional market moves, especially during moments like this. Let's start with the most important question. Why can silver trade at one price in the US, while the rest of the world seems to be operating under a different reality? To understand that, you need to understand how silver prices are actually set. Most people assume silver prices are determined by physical supply and demand. How much silver is mined, how much is used in industry, how much people want to buy. But that's not how pricing works day to day. The global reference price for silver comes primarily from paper markets, especially US-based futures exchanges. These are markets where silver is traded as contracts, not as metal moving from one hand to another. In these paper markets, enormous volumes of silver are traded every day, far more than the amount of physical silver that actually exists or changes hands. This means price is driven by leverage, speculation, algorithms, and financial positioning, not by someone loading silver bars onto trucks. Now here's where things get interesting. These paper markets are heavily concentrated in the US. When selling pressure hits there, the price signal goes global instantly, even if physical conditions elsewhere haven't changed at all. So when US futures markets experience forced selling, margin calls, or aggressive short positioning, the price drops fast. But physical silver in Asia, the Middle East, and parts of Europe doesn't suddenly disappear in value. Demand doesn't collapse overnight. Industrial users don't cancel contracts instantly. Yet the global benchmark price drops anyway. That's the gap people are noticing. In the US, paper silver can crash within minutes. Outside the US, physical silver trades slower, more cautiously, and often with higher premiums. That's why you can see a situation where US prices look weak, while global physical demand looks strong. This isn't manipulation in the movie script sense. It's structural imbalance. But here's the part that raises eyebrows. When prices drop in the US, you'd expect physical silver everywhere to flood the market. Sellers should rush to unload inventory. Premiums should collapse. Instead, we often see the opposite. Physical silver becomes harder to find. Premiums rise. Dealers hesitate to sell at spot price. That's not what a truly weak market looks like. Another key piece is currency. Silver is priced in US dollars. When the dollar strengthens, silver prices in dollar terms can fall, even if global demand stays the same. Outside the US, silver priced in local currencies may look far more stable or even strong. So while Americans see silver crashing, buyers in other countries see something very different. This creates the illusion that silver is collapsing everywhere, when in reality, it's often a dollar-driven move amplified by paper trading. Now let's talk about behavior. When prices fall sharply in US paper markets, who is selling? Mostly traders, funds, and institutions managing risk. These players don't care about physical silver. They care about exposure, volatility, and balance sheets. When risk rises, they reduce positions fast. Meanwhile, long-term physical holders aren't selling into panic. Many are waiting. Some are buying more. That difference in behavior creates tension between paper price and physical reality. This is why silver can look rigged from the outside. The price moves don't reflect what people are experiencing on the ground. Coin shops don't feel panic. Industrial demand doesn't collapse. But the chart says otherwise. History shows this pattern again and again. During periods of stress, U.S. paper markets dominate price discovery, even when they're disconnected from physical conditions. Eventually, those gaps close, sometimes violently. The key question is not whether silver is rigged, but whether the pricing system accurately reflects reality in moments of stress. And the honest answer is, not always. This doesn't mean silver must explode higher tomorrow. Markets can stay distorted longer than people expect. But it does mean price alone isn't telling the full story. At Silver Pules, we focus on understanding market structure, not just reacting to charts. Because if you only watch price, you're always late. If you understand behavior, you're early. Another important factor is trust. Paper markets require trust in settlement, liquidity, and counterparties. Physical markets require none. You either have the metal or you don't. During uncertain times, trust becomes valuable. When trust weakens, physical assets quietly gain appeal. That's why global buyers often step in during U.S. price weakness. They don't see collapse, they see opportunity. They're not forced to sell by margin calls or algorithmic triggers. This difference in perspective creates the shocking gap people are talking about. So is the silver price rigged? Or is it simply distorted by a system that prioritizes speed and leverage over reality? That's the real question. And here's the most important takeaway. When U.S. prices and global physical behavior diverge, pay attention. Those moments don't last forever. Either physical demand weakens or paper prices adjust. History suggests the adjustment usually doesn't favor panic sellers. You've been confused by silver lately, that confusion is normal. This market is complex by design, but complexity doesn't mean chaos. It means there are layers most people never look at. Before you make any decision, ask yourself this. Are you reacting to a price signal created by paper trading? Or are you understanding the full global picture? If this video helped you see silver differently, leave a comment and tell me what you're noticing where you live. Are prices behaving differently in your country? Are premiums rising or falling? Your comments help this channel and help other viewers learn. And if you think this video can help someone else make sense of silver right now, share it. Clear information matters most when emotions are high. This is Silver Pules. Stay calm, stay curious, and I'll see you in the next video.